This week's US jobs report comes on a Thursday, a relatively rare occurrence given the Independence Day celebrations on Friday. So, what we're going to be looking out for this meeting, well, certainly at the moment, markets are trying to gauge whether we're going to see a remaining 3 rate cuts this year or just 2. And certainly the direction of travel for the jobs market, of course, against the backdrop of controlled inflation as things stand, will be absolutely key. There's that deadline of the 9th of July coming up with regards to the potential reimposition of those reciprocal tariffs. So that is at the back of our minds as we come into this jobs report. But certainly as things stand, this is a jobs report that could make or break expectations for a July rate cut. So here are the latest expectations for the jobs report on Thursday, according to Trading Economics. You can see an expectation of a weaker non-farm payrolls figure, more around the 100K mark, down from 139. And there's an expectation by and large that we will see a sort of easing back in terms of payrolls as we go forward. Certainly ADPs have been very weak over recent months, but we haven't necessarily seen that replicated in the headline numbers thus far. Unemployment expected to remain at 4.2%, the average hourly earnings 0.2, keeping the annual figure at 3.9. Of course, that is a sort of gauge for inflation, really, inflationary pressures. And so if it gets down to 0.2, that's good news, and that could heighten calls for rate cuts from the Federal Reserve. U6 unemployment, so total unemployment, expected to remain at 7.8. And certainly it's notable that when we're looking at this, to understand that the Federal Reserve have this dual mandate, it means that they want to keep unemployment under wraps and they want to see inflation under wraps. If we see a surge in terms of unemployment, it might push them to cut rates earlier. But if we see a surge in terms of inflation, it might mean that they hold off. Well, at the moment, we don't necessarily see that resurgence in terms of inflation pressures. Now, there is an expectation from many different quarters, notably the Federal Reserve, that we will see inflation rear its head once again with the imposition of tariffs. And if we don't see inflation surge once again, then that could be a cautionary tale, because it might mean that essentially businesses within the US are having to swallow it. So see lower profitability, lower margins. The best case scenario is that the tariffs are entirely swallowed by foreign companies importing into the US or exporting to the US. But by and large, it's unlikely that they're going to do the entire move. So you either see higher inflation or you see businesses with lower profits. It's likely to be one or the other. As things stand, inflation remains essentially out of sight as things stand, but we don't necessarily know if that's going to continue. So that's one side of the coin. The other side of the coin is the jobs market, and that could come in the form of very low payrolls, which is something we haven't seen so far, or weakness could come in the form of higher unemployment, which again is not something we've seen. 4.2%, you can see here, largely flatlining over recent months. Now, we have seen an uptick in terms of those that find jobs hard to find relative to those that find jobs plentiful. That is within the Conference Board survey. And so that ratio is something that you can utilize to say, okay, there's an underlying weakness within the jobs market that hasn't necessarily fed through in terms of unemployment thus far. But it doesn't necessarily mean that we will definitely see that uptick in terms of unemployment. If we see higher unemployment, if we see weak jobs numbers in terms of payrolls, that's the kind of thing that lifts expectations that the Federal Reserve might step in, certainly against a backdrop of largely flat inflation. Now, what we can see here in terms of the wage growth figure is that we did see a relatively elevated figure last month, and that has lifted that 3-month annualized metric that I've got at the bottom. But the gray band that I've got essentially shows where we were on a 3-month annualized basis pre-pandemic. So this really highlights the fact that wage growth doesn't necessarily need to be at 2%, right? So the 2% target is inflation. That's not necessarily wage growth. And wage growth historically has run higher than that, and we're still within that band. So I didn't necessarily just want to look at on a monthly basis, because of course there's variation on one month to the next. So by taking that 3-month annualized figure and providing that band, it gives me an idea of sort of where we want to be and where would be deemed relatively normal. And that's exactly where we are at the moment. So given the fact that we saw a relatively strong figure last time around, there's a question mark on, are we going to see the same kind of thing this time? And so let's go back to it. You can see average hourly earnings at 0.4 last time, but this time 0.2. So that would really allay those fears that came around from last time that we've got underlying inflation pressures starting to build. In terms of the payrolls figure itself, like I said, expectations around that 100K mark. This is a breakdown in terms of where the jobs are being created or lost. And notably, we've got weakness over recent months when it comes to the sort of trade, transportation and utilities. So certainly that tariff concern, or those tariff concerns, have sort of weighed on US businesses alongside businesses abroad when it comes to sort of trade and transportation. We've also seen sort of weakness in terms of the creation of jobs within the government sector. You can see the pink box that was prevalent at the sort of top of each of the bars within Biden's era on the left-hand side of this chart, largely non-existent at the moment. And so that is an area, taking that and the trade side, that sort of caps things a little bit over the near term. Whether we see the other areas picking up slack to overshadow that remains to be seen. But certainly those are sort of two areas where we don't necessarily see the job creation that we have seen in the past. In terms of, here we go, the ISM manufacturing and services PMI, you can see some weakness coming into play recently. And ultimately, what we need to know here really is, do we have a perception that the economy is weakening? And that can come via an expectation of where the jobs market is going, or that can come via, say, PMI numbers. And ISM PMI numbers are particularly important because you get to see a breakdown like we see here. This is for the services metrics, where you see, what's the employment outlook, what's the prices paid to the inflation side of things. And so really just within the ISM PMI numbers, you can see the two sides of the coin for the Federal Reserve. How's the job market within the employment metric? How's the inflation picture within the prices paid? And you can see by and large employment sort of around growth, is sort of stuttering a bit. But the prices paid to the inflation side of things very elevated when you look at the ISM numbers. We can see here in terms of the services and manufacturing, both relatively weak, services essentially flat at the moment at that 50 band, manufacturing weakening recently. In terms of market expectations, what we have seen of late is a little bit of an increase in terms of the expectation for us to remain as is for the July meeting. But you can see there is around about 20% chance that we see a rate cut in July. So the question mark here is whether the data that comes out around this meeting will increase or decrease the expectation for a rate cut in July or not. For me, I like to look out to the back end of the year because there's, markets by and large looking towards September as that first rate cut. And so the question mark for me is, how many rate cuts are we going to see towards the back end of this year? Because that July 9th deadline really adds a lot of uncertainty. And so, beyond that, if we don't necessarily see tariffs ramped up once again, then we could see greater clarity. If we see tariffs imposed once again in a heavy manner, those reciprocal tariffs, we could see many of these expectations cut quite dramatically. But as we've seen over the course of the past week, the past month, we've seen a growth in expectations for 3 rate cuts before year end or by year end, and a reduction in those calling for just 1 rate cut or 2 rate cuts. So people are growing increasingly confident. Part of that is that we have seen inflation remain largely stable. So far, we haven't seen that resurgence in terms of inflation. The second side of the coin would be is if we saw higher unemployment or weaker jobs numbers. So we're expecting to see 100K. Do we see payrolls drift lower? Do we see unemployment rise? If we see that, then there's an expectation of additional rate cuts coming into the fray. And we can see here the expectation, the implied rate for where rates will be by the December meeting. And so that's in the purple line. And we have seen it sort of drifting lower. I haven't necessarily seen a dramatic expectation of additional rate cuts. But as we see here, we do have that relationship between the US dollar index and the expectation for where rates will be by year end. That means if we see weak data by higher unemployment, lower payrolls, things like that, particularly in relation to market expectations, you would expect to see further weakness in terms of the US dollar. So let's jump onto the chart for the dollar index and see exactly how things are shaping up. So, of course, the trend is very much a bearish one, and we can see it here with the monthly time frame dropping down into the lowest level seen since early 2022. If we look in terms of the sort of shorter time frame, a very clear-cut downtrend in play here. So a lovely market to be trading at the moment, and it has been playing out for some time. You can see by and large, this sort of looks like a decent trend line to be following. You've got 1, 2, 3, 4 touches, more recently sort of popping up through it. But we're also going to be utilizing sort of Fibonacci levels to gauge exactly where things are standing within this trend. So very clearly trending lower here, and the combination of both trendline and Fibonacci levels are what I like to utilize to be able to gauge exactly where we are within this trend and whether we're going to see a turnaround or not. You can see here more recently coming into that 61.8 fib and then falling quite dramatically. And we're within that latest downtrend. So I don't necessarily want to draw another Fibonacci level because we're not in a retracement phase. We've broken through support. We're heading lower. We don't necessarily know how low this will go in this current leg because, as you can see, sometimes it goes very extended. Sometimes we don't necessarily extend all that much before we get back towards trendline resistance and we start to come into that next retracement. All I'm going to say here is that I remain bearish unless we see a breakout from that trend. 98,959 is the near-term swing high. If we move towards the upside, I'll be drawing retracements to that level and looking for that retracement to be exactly that, a short-term retracement set within a clear downtrend. But unless we see that 98,959, near-term gains are likely to be short-term in nature. If we look at the hourly time frame, we can see sort of sharp decline here, retracement, sharp decline. We're in this sort of holding pattern at the moment, sort of sideways consolidation. Let's sort of get some lines drawn on here. So 96,536 has been the level that 1, 2, 3, 4 times we've failed to break through. We've now broken it. So it's a good chance we do continue to move towards the downside. But like I said, if we see weak data coming in, I'll be expecting to see further downside coming into play here for the US dollar. Then we want to look at, there we go, the relationship between the Nasdaq and expectations in terms of rates. And as we can see here that we've seen this sort of divergence playing out of late with strength in terms of equities, but weakness in terms of those rate expectations. So what's happening here? Well, by and large, a weaker sort of expectation or a lower expectation for where we're going to see rates by the end of the year. It's essentially a story around, what's driving it. Is it economic weakness or is it weakness in terms of inflation? If it's economic weakness and we have growing fears around the possibility of a recession, that's not good for equity markets. But if it's weakness in terms of inflation, then that's fine, right? That's not necessarily a problem. So what we need to see here is expectations of rate cuts coming into the fore, but not necessarily driven by heightened fears of a recession. What's that mean in terms of this jobs report? Well, if this jobs report sees a spike in terms of unemployment, I don't think that's good for equity markets. If we see low sort of average hourly earnings, that's a good thing in my mind because it lowers inflation expectations. So it's an interesting one. I think in terms of a sort of Goldilocks report, when it comes to the jobs report, it's going to be a case of numbers staying relatively stable. We don't see a spike in terms of unemployment. We don't necessarily see a massive spike in terms of job creation. Somewhere in the middle is a sort of sweet spot. It doesn't necessarily lift expectations for a recession, but it also doesn't lift expectations of the Fed to just continue to hold out and hold out. And certainly we're moving into a phase where we have this talk about a potential shadow chair over at the Federal Reserve. So there are people angling for Jay Powell's role that are likely to go along with what Donald Trump says. But really, it also comes down to the data. They are going to be data dependent. So the direction of travel in terms of the jobs market is going to be absolutely key as we go forward. So like I said, we've seen the strength in terms of the equity markets, the likes of the Nasdaq doing very well with the tech names pushing towards the upside. You can see here in terms of the, say, weekly time frame, we've broken up through that previous high of, there we go, of 22239. So the trend is very clearly a bullish one. The long-term pattern shows you exactly that. So we just want to look in terms of near-term intraday trends and try and spot exactly what it would take to reverse the course. And unless that happens, then I hold the trend to be my friend. And that means a breakthrough 22379 would be required. Until that happens, near-term downside to me would be perceived as a retracement. We don't necessarily know how deep this current move lower is going to come into. But if we say grab onto that and put some, let's just put into a sort of deep fib zone. So you can see if we come into this sort of 22460, 225 kind of area, then that looks a really interesting area for the bull to come back into play. We don't necessarily know that that's going to happen. We don't know how far this retracement will happen. But for me, any retracements are exactly that. They're bullish pullbacks set within an uptrend. And if we see a breakthrough 22379, that's what's needed in my mind to negate that view. Until that happens, for me, near-term pullbacks are opportunities, and the bull trend remains in play. Like I said, it's an interesting one. We don't necessarily want it to be too hot, too cold when it comes to the jobs market in relation to the likes of the Nasdaq. So something in the middle, I think, would be nice. And really the key story here is, do we continue to see inflation under wraps? And do we see tariffs held off for the time being, and also beyond the 9th of July? If we do, then that provides the basis for further upside for the likes of the Nasdaq. I hope that's been useful. Make sure to like, subscribe, and follow for more. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Thanks a lot for watching.